SME IPOs have become one of the hottest corners of the Indian stock market. Huge subscriptions, massive listing gains, and thousands of investors trying their luck. But now, the game has changed. SEBI has tightened the SME IPO framework, and the message is very clear. SME IPOs are no longer meant to be treated like a quick lottery ticket. The entry barrier is higher, company eligibility is stricter, and investors need to do much more homework. So, what exactly has changed? And most importantly, what does it mean for you as an investor? Let's understand it step by step. First, let's understand why SEBI wanted stronger rules. SME IPO participation increased sharply in recent years. Many issues attracted extraordinary demand and very high subscription numbers. But higher participation also brought concerns. SEBI had highlighted issues around related party transactions, use of IPO proceeds, governance, and the possibility of investors entering SME stocks without fully understanding their risks. Remember, SME companies are generally smaller businesses, and their shares can be less liquid and more volatile than main board stocks. So SEBI's approach has been simple. Improve the quality of companies coming to the market, improve disclosures, and make investors think twice before putting money into a risky SME IPO. Now comes one of the biggest changes. Under the amended framework, the minimum application size for an SME IPO is 2 lots, and the minimum application value has to be above 2 lakh rupees. That is a major change from the earlier 1 lakh rupee threshold. Why did SEBI do this? The idea is to reduce participation by investors who may not have enough risk capacity or understanding of SME stocks. In other words, SME IPO investing is becoming less accessible to very small investors. But there is an important point here. A higher minimum application does not mean the investment is safer. If you put 2 lakh rupees into an SME IPO, the risk is still there. So don't confuse a higher entry ticket with lower risk. The current SEBI framework specifies a minimum application of 2 lots and a value above 2 lakh rupees. This change is important because many investors started looking at SME IPOs primarily from the perspective of listing gains. Apply, get allotment, sell on listing day. But that strategy can be dangerous. An SME stock can have lower liquidity, wider price movements, and a smaller investor base. A spectacular listing gain does not tell you whether the underlying business is actually strong. Therefore, before applying, investors should examine revenue growth, profitability, debt, cash flows, promoter background, valuation, and the actual purpose for which the company is raising money. The new framework should encourage investors to shift their mindset from "how much listing gain can I make?" to "what kind of business am I actually buying?" Another important change is the profitability requirement. Under the revised framework, an SME seeking an IPO has to meet a profitability condition involving operating profit of at least 1 crore rupees in at least 2 of the 3 preceding financial years. Why does this matter? Because the regulator wants companies entering the public market to demonstrate a stronger operating track record. This doesn't mean every company will be financially perfect, and it certainly doesn't mean an SME IPO cannot fall after listing. But it does create a higher quality filter before a company reaches public investors. For investors, this means one thing. Don't look only at the IPO subscription numbers. Look at the company's actual operating performance. SEBI has also tightened the rules around offer for sale, or OFS. Under the revised framework, the OFS component in an SME IPO is capped at 20% of the issue size, and an individual selling shareholder is subject to an additional limit. Why is this important? Because investors generally want IPO money to help the business grow. For example, expanding capacity, increasing working capital, investing in technology, or reducing eligible debt. If too much of the IPO is simply existing shareholders selling their shares, investors may reasonably ask, how much money is actually going into the business. The new framework puts greater emphasis on the fresh capital raising purpose of SME IPOs. Another major investor lesson is the use of IPO proceeds. SEBI has tightened the framework around how companies can use the money raised from investors. General corporate purposes are restricted. The amount cannot exceed 15% of the gross proceeds, or 10 crore rupees, whichever is lower. There are also restrictions around using issue proceeds to repay loans taken from promoters, promoter groups, or related parties. This is important because investors should always ask, where exactly is my money going? Is it being used to expand the business, build a new facility, increase working capital, buy technology, or simply provide an exit to existing shareholders? The answer can make a huge difference to the investment story. SEBI has also strengthened the disclosure and review process. The draft offer document of an SME IPO is subject to a public review period, giving market participants an opportunity to examine the information and raise concerns. This is important because an IPO document contains critical information about the company, business risks, promoters, financial performance, related party transactions, objects of the issue, and potential risks. But remember, just because a document is available publicly does not mean investors should assume the company is safe. Read the document, understand the risks, and never invest simply because an IPO is heavily subscribed. So, what does all of this mean for SME promoters? Getting listed is becoming more demanding. Companies need stronger financial credentials, clearer disclosures, and greater accountability. For genuine businesses, that can actually be positive. A stronger regulatory framework can improve investor confidence. It can also help separate fundamentally stronger businesses from companies that are primarily looking for easy access to public money. So while the new rules may make the SME IPO process tougher, the long-term objective is to create a healthier SME market. Now, if you're planning to invest in an SME IPO, here is my simple checklist. Number 1, check the business model. Number 2, study revenue and operating profit for the last 3 years. Number 3, check debt and cash flows. Number 4, understand exactly how IPO money will be used. Number 5, examine promoter background and related party transactions. Number 6, compare the valuation with listed competitors. And number 7, most importantly, check liquidity and understand that exiting an SME stock may not always be easy. Don't apply just because the IPO is trending on social media. And don't apply just because someone claims that the listing gain is guaranteed. There is no guaranteed listing gain. So, is the SME IPO market becoming safer? The honest answer is, stronger rules can improve the framework, but they cannot eliminate investment risk. An SME IPO is still an equity investment. The price can fall, liquidity can be limited, and business performance can disappoint. SEBI's new framework is therefore a reminder. Don't invest because everyone else is applying. Invest only after understanding the business, valuation, and risks. If you found this video useful, share it with someone who is interested in SME IPOs. And subscribe to Naveen Finance for simple explanations of stock market and personal finance topics. Remember, knowledge first, investment second. This video is for educational and informational purposes only. It is not investment advice. Please do your own research and consult a SEBI-registered investment advisor before making investment decisions.